All right, here we go. The January effect. I don't know if you can see that. It says Investopedia. Definition of the January effect. A general increase in stock prices during the month of January. This rally is generally attributed to an increase in buying, which follows the drop in prices that typically happens in December when investors seeking to create tax losses to offset capital gains prompt a sell-off. All right, let's hear another one. Okay, Investopedia explains January effect. The January effect is said to affect small caps more than mid or large caps. The historic trend, however, has been less pronounced in recent years because the markets have adjusted for it. Another reason the January effect is now considered less important is that more people are using tax-sheltered retirement plans and therefore have no reason to sell at the end of the year for a tax loss. Okay. All right. Now, I am just basically saying here that, or what they're saying there is that the January effect basically means that stocks go up in January. Now, here's what I want to speak to. The great John Bollinger was fond of claiming or saying that if you have an increase the first 5 days of trading, the first 5 days you go up, that would tend to indicate that there's going to be a strong year. He gave a probability. I think he gave it up at least 3/4 probability. It's high. So let's go to the tape. I don't know if you can see this. Okay, I don't know if you can see that. I don't know if anybody can see that. That is the SPX or the S&P 500. That's the 500 largest stocks in the world. Okay? So here we go. Here's the middle of November. Here's the end of December here. Here's January. Look, we got a bounce. We got a big bounce. Okay? Let's look at the QQQs. Sorry. Bear with me. Search. There we go. The QQQs. That is the NASDAQ 100. Here we go. They started the year down here at what? 63. Now they're at 66. So that's what? So you went from 63 to 66. That's a 5% jump in 5 days. That's a big jump. That's a big jump. Let's look at gold. Gold is down. What that would tend to be indicative of a stock market rise. You know, when gold goes down, people are they have been counter each other. They have been counter. There have been times when the stock market and the gold go in the same direction, but that's interesting. This looks like a very bearish chart. Very bearish. That's a lot of overhead resistance there. Let's take a look at it a little further out. Yeah. Yeah, there it goes. No, it doesn't look so bad. So gold is definitely not broken down. Gold is not broken down. Okay, let's go with the QQQs again. See what they look like. Yeah, that's a weekly chart. Yeah, up, up. Yeah. Well, this is a little concerning because this is a bit of a. This is going up and this is going down. That McCAD looks a little bearish. You know. I mean, these are going the same direction. Of course, that's not a whole lot of time for that to happen. Let's look at the spider one more time. Yeah, big time. So yeah, it looks like we're going to run a little bit. So yeah, so if Mr. Bollinger is correct that the first 5 days of the year are very strong indicators of what's going to happen, then we're going to have a very good year for the stock market. Yeah, because it's obvious that we got a pop at the beginning of the year, and it looks like everything's strong except for gold. And I think gold is counter to the stocks. I think people that buy gold tend to want to sell their stocks or tend not to want to be in stocks. I think gold is for the scared crowd out there. I think there's a crowd out there that has gold in their guns all in the same place, in their silver, waiting for the end of time, waiting for us all to be shooting each other, all those prepper types. Well, I'm not a prepper. The only thing I'm going to do if there's a prepper is take your stuff away from you if you don't shoot me first. Oh well, what a way to go. Out.